Welcome back. The economy adding 22,000 jobs in August. That was well below estimates, while the unemployment rate ticked higher. As expected, 4.3% is the new unemployment rate. Jan Hatzius, Goldman Sachs chief economist, head of global investment research, joins us now to discuss. Welcome back, Jan.
Hi.
Good to see you're still here after the president's assault, which we'll talk to you about in a moment. But just reaction on jobs to this weaker print.
It was a little bit weaker than we had expected, but we'd been looking for a somewhat soft report with an increase in the unemployment rate, with a sort of sub-consensus job gain. I think the implication is that the labor market continues to be pretty slow. Hiring is very slow. Layoffs are still low, but the labor market's softening. And my main takeaway is that this seals the case for the cut in September that we've been looking for a while, and probably additional cuts beyond that. We have cuts in October and December as well, and I think that looks quite likely. Obviously, that's going to depend on the data, but I feel very good about the forecast.
There's also this debate about whether the Fed can start cutting now and help shore up the job market. Does it work that way?
Well, that's the idea, that you move closer to neutral, and that supports the job market in a period during which hiring is quite soft. And yeah, at the margin, that should be expansionary and shore up the job market, as you say.
There was some discussion yesterday out of ADP that maybe the break-even was higher than we think, and that it might have resulted in a 4.5 print today on unemployment. Did that make any sense?
Well, 4.5 would have been a very large increase. So I thought, I don't think that was really on the table. Obviously, month-to-month changes in the unemployment rate can be noisy, so you always want to look at a range of different indicators. But we'd been looking for 4.3%, and that's what we ended up getting.
So no SOM rule risk, your recession odds are still, I think, in the high teens, maybe?
We have it at 30%.
Oh, really?
We've been there for a while, but that's it on net over the last few months. It's been edging down. I think the consensus is somewhere in the 30s. But I think, we'll be watching the unemployment rate, obviously. We are adding jobs below the break-even rate. We think that's probably in the sort of 80,000 range or so, probably coming down over time. But, right now we're adding a relatively small number of jobs every month.
So is it the case, and can it be the case, that job growth slows down like this and the overall economy holds up pretty well?
Well, that's what we've seen so far. The economy is still growing. GDP is growing, somewhere in the mid to high ones, probably in the third quarter. And that's our forecast for the remainder of the year. As we go into 2026, we have sort of gradual reacceleration back to something closer to a trend pace. We put trend U.S. GDP growth, potential growth, at about 2.25%, and we think that we'll be moving in that direction. That's the baseline. Obviously, lots of new information all the time, and we'll update our forecasts, but that's what I'm expecting.
You think you have the year-end? Where's year-end core PCE? 3.3? Somewhere in there?
3.2.
3.2.
Yeah.
So does inflation temper a rate cut cycle at all?
Well, I think we'll still get the CPI before the next FOMC meeting. I think, nevertheless, even though there's, of course, uncertainty around that, we don't have a forecast for that number yet. I think a cut is highly, highly likely, just based on what we've seen in the labor market numbers.
So we haven't spoken to you since you got called out by the president in a post where he told David Solomon to fire you because he didn't like your analysis that consumers would ultimately pay 2/3 of the tariff. How did you react when that came across?
I mean, look, I try to focus on the things I can control, and what we always focus on is try to do the best analysis we can for our clients.
Do you stand by that consumers going to pay most of the tariff? Because we haven't fully seen that.
Yeah, we do. We think that's still a reasonable estimate. It's true that so far the the share of the tariffs that have been imposed that the consumer is bearing at this point in time is lower than that. But over time, we think that firms are going to recoup some of the additional costs that they're paying, and that's where these estimates come from. Again, these are estimates. We will see how the data evolve. we'll adjust our numbers as we always do. But that's where we stand at this point.
By the way, congratulations on winning the Lawrence Klein Award for blue chip economic forecast accuracy for an unprecedented third time. That must take some of the sting out of it.
I was certainly very happy to see that. And of course, it's very much a team effort. So we were all quite glad to see that. Yes.
I think the tide is turning because Kevin Hassett in your interview last hour cited Goldman Sachs economists, you basically raising your forecast, right?
Well, the upgrade, the potential upward revision to the August numbers. And, we don't know that yet, but historically, August numbers have had a tendency to surprise on the downside and then be revised up in the next report.
All right, something to keep in mind looking at this number today. Jan, thank you. It's good to have you back, as always, on a jobs day. Jan Hatzius from Goldman Sachs.